If I had $1 million, if I had $1 million, well, I'd buy you a house. I would buy you a house. And if I had $1 million, if I had $1 million.
Alrighty, continuing on, let's start talking about monetary policy, and what we're going to do today is kind of talk about the nuts and bolts of how the Fed actually does monetary policy. Quick review from last time. Remember, monetary policy is all about managing the money supply to promote certain macroeconomic outcomes. Specifically for the Federal Reserve and the U.S. economy, they have the dual mandate where they're supposed to keep long-term prices and interest rates stable, to keep inflation low, and to ensure maximum employment in the economy to promote economic growth by manipulating the money supply policy we know as aggregate demand management. So let's get into this topic of how does the Fed do this task of monetary policy, money supply management. And we'll start off with there's two basic things the Fed can do with its vast powers. It can do, first off, what we call monetary targeting. We start with the realization that the Fed controls the monetary base. It controls the amount of reserves in the economy. Okay. There's a multiplier which determines the level of M1 and M2 based on the level of that monetary base, and the Fed knows, or at least can estimate, what the multiplier will be going forward. Therefore, the Fed can target the size of the money supply by adjusting the level of reserves according to what the multiplier is, according to what they want the overall money supply to be. Better yet, what the Fed will typically look at, what central banks will typically look at, is controlling the growth rate of the money supply by managing the growth rate of the monetary base according to what the multiplier is. And let me show you how this works with respect to that monetary pyramid diagram. Here's our monetary pyramid where we have monetary base, which remember is currency plus reserves. Let's add on M1, which is currency plus demand deposits. M2 includes M1, which adds in time deposits or savings accounts. Time deposits is savings. Demand deposits up here is checking. Here's the total money supply. Reserves and currency in the base, currency and demand deposits in M1, currency, demand deposits, and time deposits in M2. Fed controls the growth rate of the base. So I want us to envision monetary policy isn't really determining the amount of money in the economy. It's properly thought of as determining the growth rate. So let me just show you some options here. The Fed can dial up the growth rate of the base, and I'll just arbitrarily choose some values. Let's say they can increase it by 4%. That would be this line right here. They can increase it by, let's say, 8%. That would be this line right here. Or they can increase it by, let's say, 12%. That would be this line right here. Okay. There's a given multiplier, so that means for whatever growth target the Fed chooses for the monetary base, if the multiplier holds up, we'll see a corresponding growth rate in M1. Okay, so we'd see maybe a 4% if the Fed chose this level of base growth, or we'd see the 8% if the Fed chose this level, or we'd see 12%. Okay, we're going to see a proportionate increase in M1, and then likewise proportionate increase in M2. It's all about the multipliers here. Okay, so let me just give a quick numeric example, and this will be pretty easy to understand. I don't want to spend a lot of time on monetary targeting because it's actually hasn't been the chosen method for the Federal Reserve for more than 30 years, but it is helpful to understand how monetary policy works. So let's say the M1 multiplier equals 2, just to pick a nice round number. And let's say the base is currently 100 billion. M1 is currently, of course, 200 billion, 2 times the base. The Fed wants to achieve, let's say, that 4% growth of M1 for the current time period. That would increase M1 by 8 billion. Okay, so to achieve an 8 billion increase in M1, what does the Fed need to do up here with the monetary base? If the multiplier holds up, and we'll assume for right now that the multiplier stays constant and steady, what the Fed will need to do here is just do a 4% increase in the base. So the Fed will add 4 billion of monetary base. The Fed will pump 4 billion of reserves into the banking system, which will then do the multiplier thing, expand loans and deposits on top of that, and we'll wind up with a M1 of 8 billion, and then we'll wind up with M2 that's grown by 4% as well, whatever the M2 numbers are. Can skip that for now. Central banks will use this method. This is going to be a useful method when you've got inflation problems, because let's think about inflation problems in terms of the quantity theory of money, MV equals PY. You've got high inflation. That means you've probably got pretty high money growth. And to tackle inflation, you want to zero in on that money growth rate and you want to pull it down. So let's say if you've got inflation problems, let's say you've got 25% inflation. You've probably got, I'm going to guess, something like 20, 25, 30% growth of M1. Just for simplicity, we'll say it's directly proportionate. You've got 25% M1 growth. You want to get inflation down to a manageable level, like 5%. There's no getting around the fact that you'll have to decrease M1 growth dramatically, probably something like 5 to 10%. And to do that, you'll have to decrease the growth rate of the monetary base to something like 5 or 10%. So what the central bank will do in this situation is switch from the higher growth rates of the monetary base in M1 down to lower growth rates. They'll do that by adding less reserves than they otherwise would have. So they'll add a smaller amount of reserves to try to bring this growth rate down rather than adding a lot of reserves like they previously had been. Okay, this is monetary targeting. Again, it's typically used to when you have chronic high inflation problems. You don't care, really, to get rid of high inflation, you don't care about anything else in the economy. And by the way, you know that when you decrease the growth rate of the money supply, you're going to have a negative aggregate demand shock, aren't you? And with a negative aggregate demand shock, what are you going to have? You're going to have a decrease in output, economic output, GDP production in the short run. And you're going to have an increase in unemployment in the short run. In other words, you're going to have recession. I'm sorry to break it to you, but if you have chronically high inflation, to get rid of the inflation, you have to use a negative aggregate demand shock because you have to reduce the growth rate of money. You basically have to take your economy through a recession. That's why, and if you watched a piece by Milton Friedman that I post, I think I'm actually posting it alongside this video. He'll talk about once inflation gets started, it's very difficult to stop. It's like a drug. It feels good at first when you're doing it, then you get hooked, and then it's very difficult to get off of it because you have to go through a period of withdrawal. And monetary targeting will be the remedy. It's kind of a tough medicine to take sometimes because it might entail a recession, but this will be the remedy when you have chronic high inflation. The second thing, and this is going to be a lot more relevant for the Fed, the modern Fed for the past at least 30 years, is going to be interest rate targeting. The Fed can dial into money growth rate, but typically the Fed is going to be more concerned not about the growth rate of the money supply per se, but about credit conditions in the economy. In other words, interest rates and the access to credit for businesses and consumers. So let's go back now. We should be familiar with this concept of the credit market. This is going to be just a very simplistic and very abstract notion here, but it'll be fine enough for our purposes. There's, in reality, lots of different credit markets. It's highly segmented. And it's not this simplistic, but for illustration, this will work just fine. The market for credit, for loans, for financial capital. Okay, the price, of course, is the interest rate. If you're borrowing money, you have to pay an interest rate. If you're loaning money, you earn an interest rate. And down here we have the quantity of loanable funds, QLF. And just a normal market, we've got a demand, which is the marginal value of getting access to funds. For businesses, recall, want to borrow money to invest in capital. Their demand is going to be based on their projected return on their capital investments. So if there's great investment prospects, that would shift the demand for investment to the right. If there's not very good investment prospects, that would shift the demand for investment to the left. Important points to keep in mind when we talk about recession. And a supply. This is based on the amount of money that people choose to save, to not consume out of their incomes, and to put into credit markets, to put into the bank. And that's based on, we could say this is the marginal cost of their evaluation of present versus future consumption. If you save money, you're not permanently saving it. You're setting it aside so you can consume more in the future relative to right now. And so for individuals who are choosing to save or consume, that decision is based on their own evaluation, and this comes ultimately down to their own preferences of present versus future satisfaction. And indeed, we say the term for this is called time preference. This means how much do you prefer present versus future consumption. But we have these factors at work in the economy, and therefore we have some equilibrium level of interest rates. I'll just call this I star, and some equilibrium quantity. Again, there's many credit markets. This is an oversimplification, but this is just to illustrate. A quantity, an equilibrium quantity, and an equilibrium interest rate. Now, go back to the Austrian business cycle, Hayek's business cycle story. And we know that when the central bank gets active, in pumping up the money supply by issuing reserves, what happens here is they cause a rightward shift in the supply of credit. Now, Hayek will kind of be very skeptical of this because he says, well, this is not actual resources that are being saved by individuals, but hold those thoughts to the side for right now. We just want to see how this functions in the credit market. We know that there's an increase in supply. In fact, we can use the same terminology. This is supply plus delta M that the Hayek business cycle uses, credit expansion. In a few minutes here, we'll look at the kind of the mechanism of how the Fed puts the money in. But the Fed puts money into the banking system. The banks can now make more loans. We can climb down the demand curve, and we're going to increase the quantity of loans because banks can make more loans. So we increase the quantity, call it Q prime, quantity of loanable funds. And at a higher quantity, it's a lower marginal value, and it's a supply curve that's shifted out. So we realize that the interest rate is going to go down. Call it I prime. The interest rate goes down. Well, what does this indicate? The Fed can add more funds if it wants to push the interest rate down even more. If the Fed wants to push interest rates up, why would you ever want to do that? We'll talk about that. We'll focus on that a little bit in the next unit, but you push interest rates up essentially when inflation gets too high. The Fed wants to push interest rates up here. It'll reverse the process. It'll pull reserves out of the banks until the quantity of lending goes down, or at least the growth rate of lending goes down, and then the interest rate will climb back up. This is the essence of what the Fed is doing these days in the modern era with respect to money supply management, monetary policy. We are in a regime with our Fed that is focused on this mechanism, this tool of interest rate targeting. You want to keep this in mind, and you kind of plug this concept into everything else we'll talk about in the remainder of this lecture. Okay, so with that in mind, we know the Fed controls the monetary base or reserves in the economy. Therefore, they can influence interest rates through the credit supply channel by shifting that supply curve of credit outward or inward as they deem appropriate. Okay. Let me point out here one little caveat. The Fed cannot control interest rates permanently in the long run. The Fed will push interest rates down in recession if it wants to stimulate aggregate demand, boost the quantity of money, maybe try to bring inflation rate up. The Fed will push interest rates down. But they can't permanently hold interest rates at a level that's below the equilibrium market rate. And the basic reason is if the Fed keeps on adding money to the banking system to hold the interest rate down, that will eventually build up inflation. And as we learned with the Fisher effect, inflation will eventually push interest rates back up. And vice versa, if the Fed tries to hold interest rates too high, well, that'll reduce inflation. If the Fed really overdoes it, that'll cause deflation, and deflation will pull interest rates back down. So the Fed can manipulate rates in the short run, but in the long run, they ultimately are a factor. They ultimately are a function of market forces, supply and demand in credit markets. Let's take a look at the interest rates, some interest rates in the U.S. economy, and we'll talk about how the Fed operates here. Start off with what's known as the federal funds rate. Now, the federal funds rate, we say the Fed changes interest rates. The Fed really doesn't go out and set an interest rate. The Fed will add or subtract reserves from the banking system until it gets a certain interest rate that it's interested in at the level it wants it to be at. And that interest rate is going to be the federal funds rate. Now, the federal funds terminology can be a little misleading because it actually has nothing to do with the Federal Reserve. The federal funds market, this is what we call the interbank reserves market. Banks will loan each other reserves. We talked about that in the last lecture. A bank that's low on reserves will go and borrow some reserves from another bank. That's what the federal funds market is, and that federal funds rate is the rate that banks have to pay each other for temporary loans of reserves. Now, what the Fed will do is put reserves into the banks, add a lot of reserves. It wants to push the federal funds rates down, and it will pull reserves out or just decrease the amount of reserves it's adding to the banking system if it wants to pull the federal funds rate up, like right here. And the Fed can control the federal funds rate through daily manipulation of reserves fairly accurately. Okay, what do you think the Fed wanted the federal funds rate to be in this period right here? And this looks like about in 2006, 2007. leading into the recession here. It looks like about 5.25%, and they targeted that level and they're able to dial it in pretty darn close. Okay, what does the Fed want the federal funds rate to be right here? And this is probably mid 2008. They want it to be 2% exactly, and they dial it in, they get it to that level. What does the Fed want the Fed funds rate? Oh, let's go back here to the 90s boom. Right here, the Fed wanted the Fed funds rate to be 3%, and you can see it bounces around month to month. But if it goes up too high, the Fed will take steps to pull it back down. If it goes down too low, the Fed will take steps to pull it back up high. And over a long run, the Fed can get that rate dialed into exactly where it wants it. Okay. Currently, what does the Fed want the Fed funds rate to be? It's almost zero. It can't go below zero. Currently, the Fed's rate target for the federal funds rate is 0 to 0.25%, not even 1%, 1/4 of 1%. That's the highest it'll be here. You'll see there's kind of an upper limit, and of course it can't go below zero. No bank would lend at a rate of 0. That just wouldn't make any sense. So it can bounce around within a range, or it can be at a certain fixed level like we saw right here. Okay? And the Fed will raise it and lower it. This is what monetary policy is all about nowadays. Okay? Raising and lowering interest rates, trying to affect the flow of credit, the availability of loans, the cost of loans, the level of aggregate demand in the economy. This is called the credit channel. Well, let's move on and look at some other interest rates. Okay. The blue line is the federal funds rate, the one that the Fed targets. The Fed will try to dial that into the level it wants it to be through its monetary policy operations, open market operations, which we'll talk about here in a minute. I've shown you some other interest rates. There's a whole bunch of interest rates, as I mentioned, but here's some important ones. The red one is the prime interest rate. This is a rate that banks offer to their best business customers. Okay? Strong businesses with good credit and lots of assets. Businesses have credit scores just like individuals do, and lots of assets to pledge as collateral, can typically borrow at the prime rate from banks in their community. The prime rate, I don't know why this chart cut it short, but the prime rate is currently right here hovering about 3 percentage points higher than the federal funds rate. So the prime rate is currently 3.25. But you'll notice when the federal funds rate goes up, the federal funds rate got really high in about 1980-81. The prime rate got even higher, but it moves right up with it. Okay, the prime rate peaked here at about 21% in 1981. When the Fed funds rate comes down, as it comes down in the early 80s, and then it comes down into the 1990s, the prime rate comes right down with it. Okay. So the stance of interest rates that the Fed sets with the federal funds rate will generally influence pretty strongly, and there's a strong correlation here, other interest rates in the economy. We looked at the prime rate. Let's look at the mortgage rate. My green line here is a 30-year conventional mortgage. What's a conventional mortgage? This is generally viewed as a pretty safe mortgage where people put 20% down. People have a certain minimum, fairly high credit score. So people with strong credit who can make a 20% down payment on a house, they can borrow at the 30-year conventional mortgage rate. And you'll notice this is not quite as sensitive as the prime lending rate, mainly because it's got a much longer maturity, which means it's subject to other kinds of risks. But it'll generally move in line with the Fed funds rate, the overall stance of monetary policy as well. You'll see that 30-year mortgage rates peaked up here in maybe the 16-18% range when all interest rates were high. When all other interest rates came down, the mortgage rate came down, and it gets lower and lower. And now with federal funds rates close to 0, which is as low as they've ever been, as low as they can possibly go, the prime lending rate fairly low. Mortgage rates are pretty low as well. Currently, I think it's around 3.5%. I think it's gone up a little bit in the last couple of weeks, but it's about 3.5%. You'll notice here that's lower than it's been. This chart goes back 40 years. Okay, that's lower than it's been. I think it got down to its lowest level we've ever seen it here. It's come back up a little bit recently right here. But just notice here, when the Fed pulls the interest rates down, what the Fed is actually doing is pumping reserves into the economy to get the federal funds rate to where it wants it, but that'll tend to pull other rates down as well because banks have more reserves in general. What do banks do with reserves? Well, they make all kinds of loans, not just federal funds loans, but they'll make mortgage loans, business loans, credit card loans, car loans, so on and so forth. The Fed isn't setting interest rates directly, but it's influencing interest rates through its capacity to pump in reserves and at a faster or slower rate into the banking system. And this is what monetary policy is all about these days, is what monetary policy focuses on, these credit market effects. Okay. So with that in mind, now we can go into how the Fed actually does this, and we'll talk about instruments of monetary policy. The most important instrument, and the one I'll spend the most time on, and the one you really need to have a thorough understanding of, is open market operations. Basically, what the Fed is going to do here is control the amount of reserves and the growth of reserves in the banking system by buying and selling government bonds. Specifically, we're going to focus on T-bills with pure open market operations. T-bills are short-term government securities. Typically, they're very short-term. They're bonds, but they're actually called bills because they mature in 30 days or 60 days. A bond typically has a longer maturity of something like 20 or 30 years, but they're the same thing. It's a standardized loan with a standardized face value, $1,000, and a set interest rate. Okay, so it's kind of a package standardized loan. That's all a bond is, or a treasury bond or a treasury bill. The Fed buys and sells government bonds from banks to alter the amount of reserves in the banking system. Remember that the Fed has total control over reserves. The Fed can print reserves. They're literally not usually printing currency, but they're adding reserves or subtracting reserves at will from the banking system. What this means is that the Fed can buy as many T-bills as it wants.
Honey Badger don't care. It just takes what it wants.
The Fed doesn't care. The Fed can do what it wants. What it wants to do sometimes is print a lot of reserves, issue a lot of reserves, and buy a lot of T-bills from banks in order to boost the money supply, to lower interest rates and increase lending and boost aggregate demand, or vice versa. Okay? So you have to realize the Fed has basically an infinite capacity to increase or decrease the amount of reserves in the economy. So the Fed can add reserves by buying government bonds from banks, and that'll have the predicted effects of pushing interest rates down, pushing money growth up, and boosting aggregate demand. Or the Fed can do the opposite. It can sell T-bills back to the banks and pull reserves out of the banking system. And that has the opposite effect of pushing interest rates up, pushing money growth down, and reducing aggregate demand. Okay. And note here that when the Fed takes reserves back out, the Fed is not a commercial bank. The Fed's not seeking to boost its loan portfolio to make money. So when the Fed takes reserves out of the banks, they're essentially what I call extinguished. They're not part of the money expansion process anymore. So when the Fed does the opposite, pulls reserves out of banks, it can reverse money growth. Let's go back to our old standby here of the bank balance sheet to just think for a few minutes about how open market operations work. Let me just quickly review what happened when we saw a person come in and deposit some new cash. Person deposits $10,000 of new cash. What does the bank do? It loans out 90% of it. How does it fund the loan? Remember, it creates a checking account for the borrower. Now we know the checks will be written on this account. It'll go down to zero, and the checks will be presented for payment, and the bank will have to transfer reserves to another bank. So the bank's cash position will go down to 1,000. Now let me be a little more realistic. Let me flesh out the rest of this balance sheet. And let's say that this bank also has some T-bills, some short-term government bonds. Let's say it has 10,000 worth of those, and let's say its plant is valued at 10,000, just to keep the numbers really simple. Now, we know that whenever a bank gets new reserves, it's going to expand loans. Does it matter whether those reserves come from your deposit right here or from the Fed itself? Nah, it doesn't matter. Here's what happens when the Fed does open market purchases. The Fed is going to give the bank some reserves, use the same number again, 10,000, by doing what? Buying off the bank's T-bills. So the Fed says, here you go, here's 10,000 of reserves, can we have your T-bills? Sure, so the account for T-bills goes down to zero and reserves goes up. Notice the balance sheet hasn't changed yet. We're still at 30,000 total assets, 30,000 total liabilities and equity, but with 10,000 fresh reserves, what's the bank going to do? That's right, it's going to loan it out, 90% of it. Okay, so we're going to increase loans by 9,000 again. Same exact process will set in. We're going to increase loans by 9,000. Okay, by opening a checking account for the borrowers are going to write checks. The checks are going to get cleared. The checking account gets drawn down to 0. The amount of cash gets drawn down to 1,000, and we're off to the races with that, hopefully by now very familiar deposit expansion process. Okay, so that's open market operations. Okay, this could be from the influx of cash / reserves, could be reserves from the Fed. It's going to have the same effect as cash from depositors. Okay. If you can understand kind of how the balance sheet works and the logic of this, I think you'll be in really good shape. Everything from here on out will hopefully fall into place for you. Okay. So let me summarize open market operations, and I'll kind of give you the definitions and the predicted effects here. Open market purchases, the Fed is buying government bonds, T-bills from banks. With open market operations, just let me give you a hint here. Think in terms of the Fed. What is the Fed doing? Buying and selling. Where's the Fed getting the money when it buys? It's printing it. Okay. Fed is printing new reserves to pay for the purchases. Banks receive the reserves. Okay, they give up the T-bills over to the Fed, and when banks get more reserves, they make more loans. Therefore, money supply, the growth rate of the money supply is going to go up, and interest rates are going to go down. Okay. This is labeled expansionary or easy monetary policy. This tends to increase aggregate demand, total nominal spending growth, because we're increasing money. We're reducing interest rates. We could talk about price level effects. We could talk about credit channel effects, but all these things, to simplify, they just boost aggregate demand. If the Fed wants to do the opposite, it will just unwind open market purchases. How do you unwind a purchase? By selling the thing back. Okay. So here the Fed will sell the government bonds, the T-bills, back to the banks. The banks pay by having their reserve accounts drained down at the Fed. When the Fed gets the reserves back, remember, it extinguishes them. They're no longer active, so to speak, as part of the monetary base. When banks have fewer reserves, they make fewer loans. Therefore, the growth rate of the money supply goes down, interest rates go up, and we call this contractionary or tight monetary policy. This tends to push aggregate demand back down, or at least the growth rate of aggregate demand back down. Okay, so that's open market operations. Learn it, love it. Okay, so if this were about 5 or 6 years ago, we'd be done now. But unfortunately, we've had a financial crisis since then, and the Fed has had to kind of pull out some new tools out of its toolkit to deal with some new and unprecedented events. So with that in mind, we have to talk about something else the Fed does, which is essentially similar to open market operations. So if you can understand open market operations, this should be no sweat to understand, even though it's kind of got a funny sounding name. It's popularly referred to as quantitative easing. The technical term that the Fed uses is large-scale asset purchases. But here's the situation that the Fed faces in the financial crisis of 2008. What to do if you push short-term interest rates, the federal funds rates, all the way down to 0? They can't go lower than that, but you still want to engage in monetary expansion. You still want to boost aggregate demand through monetary channels. You've pushed short-term interest rates all the way down to 0. Then what? Okay, we call this the zero bound monetary policy. Well, hope is not lost if you want to do expansionary, stimulative, aggregate demand boosting policy. Okay, you push short-term interest rates all the way down to 0, but long-term interest rates, as if we go back and look at that 30-year, in fact, let's run back and look at this. Long-term interest rates aren't 0. Okay, 30-year mortgage rate here. 30-year mortgage rate. 30-year mortgage rate is only down to 3.5. It's lower than it's ever been, but it's not 0. Okay, 30-year government bond rate isn't 0. Even the prime credit rate, which is a short-term rate, it's not 0. It's still above 3%. Okay, so you can pull short-term rates down to 0. You can't do anything more with short-term rates, but you can start working on these longer-term rates. Here's the prime credit rate. It's at 3.25. Here's the 30-year mortgage, it's at 3.5. You can still try to exert downward influence on those rates if you want to loosen up the flow of credit in the economy and expand lending, and therefore expand money growth. Okay. So back to quantitative easing here, we'll see that the Fed has a tool it can use to bring long-term interest rates down. How's it going to do this? Well, instead of purchasing short-term government bonds to bring short-term rates down, it's going to purchase long-term government bonds to bring long-term interest rates down. And I'll give you a quick lesson on bond pricing here. If you take finance, which I strongly recommend you do, or even accounting, you probably learned this principle. Bond prices are inversely related to interest rates. When bond prices go up, interest rates go down. Okay. When the Fed decides it's going to purchase a big pile of long-term government bonds, that increases demand for those bonds, and that reduces the interest rate on those bonds. Okay. Same effect is happening with open market operations. Okay. Demand for short-term government bills goes up, their interest rates go down. The Fed can use the exact same logic and the exact same kind of technique to bring long-term interest rates down. Okay. And in a while here, we'll look at the Fed's balance sheet, which kind of indicates what the Fed has been up to lately, its response to the financial crisis. What the Fed did first off when the financial crisis hit was focus on bringing mortgage rates down. So it purchased not government bonds per se, but it purchased actually mortgage bonds, which are pooled mortgage obligations. And when the Fed buys a lot of mortgage bonds, that pushes mortgage rates down. Let's go ahead and take a look at this. This is maybe a little intimidating graphic, but it's actually really easy to understand. What this is the Fed's balance sheet, which is the stuff the Fed owns. This is basically the asset side of the Fed's balance sheet. And it goes back to 2005. Look, and you can see the date down here at the bottom. 2005, 2006, into 2007. The economy was humming along just fine. You'll notice the Fed's balance sheet didn't do much. It's largely composed of U.S. Treasury securities. That's the thing in red right here. You can see on the right hand side that's highlighted. Okay, the Fed has 740, 750, 770, just a steadily growing amount of Treasury securities, which it's obtaining through open market operations. And you want to realize open market operations, it's about setting the growth rate of the monetary base to set the growth rate of the money supply. Interest rates could be going up or down in the meantime. Okay, but this is just a normal monetary policy environment. You'll notice there's very little of things like repos, things like direct bank lending. There's very little of that. There's only a few million really of bank lending, because in a normal economy it's very rare for banks to have to come borrow money from the Fed. It's common that banks will have to borrow reserves, but they can go to that interbank market. They can borrow reserves from each other. That's the federal funds market. It's very rare, so the amount of bank lending is typically very small. You can see that's that little layer here at the top. Okay. Now the financial panic actually starts in late 2007. You can see that the amount of Fed repos, that's a form of lending the Fed does. So liquidity swaps, it's another form of lending. Direct bank lending, that starts to balloon in late 2007 into early 2008. And then here's where the financial crisis really hits, starting in about August, September of 2008. And then bam, by October, November 2008, the financial crisis is upon us. And you can see that the amount of direct bank lending, which I'm focusing on right here, is up to almost 600 billion. Central bank, the Fed is lending equal amount of money, something 500-600 billion to central banks. It's lending money to other kinds of financial institutions, money markets. That's doing repo lending. It's doing bailouts of these companies, Bear Stearns and AIG. We'll probably come and talk about this later. But it's also later on, once the financial crisis settles down a bit and the Fed turns its attention back to more traditional monetary policy, trying to boost aggregate demand and stimulate the economy, what the Fed's going to start doing is purchasing mortgage-backed securities. That's this big blue area right here. And you can see by the height of this policy, the Fed is holding $1.1 trillion worth of mortgages. Okay. Why is the Fed doing that? Well, when the Fed buys mortgage-backed securities, that pushes mortgage interest rates down. Okay. This is large-scale asset purchases or quantitative easing. Okay, and this is what's called QE1. The Fed is purchasing a lot of mortgage bonds. You'll notice that all the other lending kind of gets wound down. The financial crisis has receded, but the Fed is doing some extraordinary monetary policy because it's brought short-term interest rates, as of late 2008, it's brought short-term rates down to zero. So moving forward, it's focused on bringing long-term rates down. Okay, that's QE1. You'll notice that the amount of Treasury securities, government bonds, starts to grow rapidly in towards the middle, fall of 2010. Yeah, from fall 2010, about November 2010, the Fed starts really ramping up its holdings of treasuries. This is QE2. The Fed starts purchasing long-term government bonds, 10, 20, 30-year government bonds to bring long-term interest rates down. What's the purpose of this? Well, ostensibly it's to bring long-term borrowing costs down for businesses and consumers in the economy to help stimulate credit, the flow of credit, borrowing, spending, aggregate demand. But also I want to just draw your attention back to the second aspect of central banking. They help support government borrowing through holding interest rates down on government bonds. Is this an aspect of that? Some people say yes, most people say no, but some people say, this maybe is that aspect of the central bank helping the government finance its debts by eating up a lot of the government's debt. And a lot of people kind of view this as unsavory, and here's why. Where does the Fed get the money it uses to buy all of these government bonds? It prints it. Okay? The Fed can print money and buy as much government bonds, basically swallow up as much government bonds as it wants. That's a little unfair. That's a little unsavory. People think that's the Fed is doing the government a pretty big favor there. And this chart here only goes up to August 2012. Recently, September 2012, recently the Fed has kicked up its buying of government bonds and mortgages, and the balance sheet has just gone up and up and up, and people are starting to use the M word as the Fed monetizing government debt. There's some, I think, some valid worries about that. We can address that later on. Let's get back to monetary policy, though. What I want to do with respect to quantitative easing, okay, large-scale asset purchases, here's QE1 with mortgage-backed securities, here's QE2 with government bonds. I thought I would treat you to a song. It's one of my favorite monetary policy songs that came out at the height of the quantitative easing debate.
You know, baby, in the years I've been your central banker, we've done a lot of overnight repo lending. And it's been good. It's been so good. But the economic situation has gotten serious now. And baby, one night just isn't enough. I want the Fed window to open up, and I want to go longer. I'm not talking about 2 nights, 3 nights, a week. I want to go all the way out the yield curve. Quantitative easing, the time has come to relever. Lending short term, baby, that's just teasing. I want to lend forever. Now the credit markets are misbehaving. I think they need a spanking. That's why I'm ready to show them some very special central banking. Short-term interest rates are very, very low, my beautiful, beautiful little U.S. economy. But if I limit myself to the $2 trillion in mortgages and treasuries I've already bought, I will go out of my mind. So I want to buy more. More 2-year notes. More 5-year notes. More 10-year notes. Baby, I want to buy the long bond. Quantitative easing. We're going to save the nation. It's 1 part pleasing and 5 parts act of desperation. I've heard some people say that quantitative easing could be too much. But when you have an overvalued currency and the ongoing threat of deflation, you can print $1 trillion, $2 trillion, $3 trillion. I don't think it can ever be too much. Oh, quantitative easing. We can't target the interest rate. We're gonna have to quantitate.
So let's back to our monetary policy discussion here. What I want to do now is talk about some other instruments of monetary policy. Open market operations and quantitative easing are the biggies, but there's a few other things that bear mentioning just briefly. Some things the Fed has done traditionally, and some things that are more recent kind of innovations. And probably the most important one to focus on is interest on reserves. Since the panic of '08, the Fed has pumped a large quantity of new reserves into the banking system. I'll show you a chart here on this in a minute. Why? Well, basically, we can talk about this later on, but basically you can just understand that there's a big financial crisis, a big liquidity crisis, so banks need to borrow a lot of reserves. People are pulling money out of banks. Banks need to borrow a lot of reserves. Also, the Fed is trying to keep aggregate demand from declining. Okay. Having learned its lesson from the passive Fed of the Great Depression, the Fed is being very, very active in trying to forestall a decline in aggregate demand, total nominal spending. Because of other factors like velocity going down, the Fed might have to pour a lot of money in, a lot of reserves in. Okay. And when this first happened, people are thinking, whoa, that's a huge increase in the monetary base. With the multiplier effect, that could lead to an increase in the overall money supply, and that could set off some major inflation. Well, traditionally, yes, but what you have to realize is that in this panic, the velocity of money has been going down. Okay. The money multiplier is going down. The M1 multiplier actually goes to less than 1. That's crazy. We've never seen an M1 multiplier less than 1, basically ever. That's quite amazing, actually. What this tells us that the economy is going through a severe negative velocity shock. Okay, banks aren't lending. Banks are holding tremendous amounts of excess reserves, whereas banks typically hold almost no excess reserves because banks don't make money. Banks can't earn interest on holding extra reserves. They don't have incentives to ever hold extra reserves. But with the financial crisis, banks, the demand for credit's down, the demand for cash is up. Banks need reserves. They don't want to lend reserves. So banks are sitting on a growing amount of excess reserves, and essentially all of the money, all of the reserves the Fed is pumping into the banking system, the banks are sitting on it. They're not lending it out, so it's not contributing to a strong growth in the overall money supply. The Fed wants to prevent the overall money supply from declining. The M1 multiplier is less than 1. Let's say, let me just give you a little illustration of this. The M1 multiplier is, let's say, 0.8. If the Fed wants M1 to continue growing even at a modest pace, the Fed will have to add more to M0 than it expects to gain in M1. So if the Fed wants to add, let's say, 8 billion to M1, we've got to add what? 10 billion in monetary base. So you can see with a multiplier less than 1, naturally you're going to have a bigger increase in reserves in the base than you are in M1, oddly enough. Most of the time the multiplier is greater than 1. I use an example of a multiplier being 2. If the multiplier is 2, to achieve an 8 billion increase in M1, what would you have to add to the base? Only 4, okay? Versus, say, a 4 billion increase if the multiplier equals 2, like a more traditional, more kind of normal multiplier. So all of these factors, banks are holding a lot of extra reserves and not doing much lending. Actually, total lending has gone down significantly during the financial crisis. The M1 multiplier is way down. Velocity has declined and continues to decline, actually. It kind of makes sense that we can kind of take a deep breath, realize that this isn't going to trigger a lot of inflation right now. Now, down the road, if the multiplier goes back up, if velocity goes back up, if banks start lending again, yes, definitely, this could contribute to a lot of inflation down the road. But so far right now, these factors are totally mitigating the increase in reserves and wiping out the inflation threat, at least in the short run. There definitely is, though, some valid concerns about inflation picking up in the long run. And here's just some of the data, some really remarkable things that happened in and kind of still in the aftermath of the financial crisis. Take a look at velocity. Okay, I've got velocity of M1, which is a red line, which is over here on the right hand side. Look how it grows. It grows steadily going all the way back to 1960, it grows really steadily. This, by the way, is when Milton Friedman is bringing back monetarism, and he says, look, velocity grows at a very steady rate. You can basically assume the growth of velocity is constant. Therefore, if you see inflation, you know it's a monetary phenomenon. Okay. Now, that relationship breaks down and it kind of bounces around here in the 80s and 90s. It will grow in the boom of the 90s and then in the boom of the 2000s. But look how it kind of collapses here in the recession since '08, and it's been going down, down, down ever since then. And it's gone from over 10 to under 7. It's lost more than 30%. That's a big negative velocity shock. Okay. We've got a negative 30% shock to M1 velocity. And M2, which is the blue line, now it's over here on the left-hand scale. It's not the same scale. It's a much more compressed scale, so but it's still going to be a significant decline. We see it gets built up to dizzying heights in the 90s boom. It will come down some in the 2000s, but you'll see a little bit of an increase during the boom years. But look at the decline in M2 velocity. It goes from almost 2 down to almost 1.5, so it's going to lose something on the order of probably about the same, something like 30 to 40% of its value. So we've got a big negative velocity shock. What does that mean in plain language? Well, that means people aren't spending as freely as they used to be. They've slowed down. They've kind of tightened up their spending. They've tightened their wallet, so to speak. So the money that the Fed pumps in isn't circulating as fast as it used to be. Okay. Finally, here's the kind of the most amazing thing I think you will ever see in all of monetary history, really, is that the M1 multiplier. Now, it had been kind of on a steady decline. I think I mentioned this in the previous lecture. But in this recession, it falls below 1. That's crazy. Okay, it's currently about 0.8, as I mentioned. That's crazy. There's more reserves in the economy than there is M1 checking account money from the banks. That means what banks are doing is not lending those reserves like we would normally expect them to do. Now, why is that? We could talk about there's a weak demand for credit. Lots of people had their balance sheets hurt. Lots of people had their credit ratings hurt. People can't borrow. People don't want to borrow. People are trying to save more. There's a lot of factors here. To summarize it in simple terms, this is an AD shock. Really nothing more to it than that. Decline in the growth, decline in the pace of spending in the economy. Finally, here's the chart of excess reserves, and this is another really wacky, really unprecedented thing. Notice going all the way back to the 1960s, excess reserves hovers essentially at 0. Okay, this is essentially 0. You see a little blip here with the 2001, the terrorist attacks, but with the recession of 2008, the Fed is pumping in a lot of money, and it's all just sitting in reserves. Okay, we've got $1.6 trillion in excess reserves. This is the bulk of the money the Fed has added to the banking system through open market operations, mostly through quantitative easing, large-scale asset purchases. Okay. So this indicates that there's not a big buildup of an inflationary pressure right now, but there could be in the future if the M1 multiplier goes up above 1, if velocity starts to grow to previous levels rather than to continue to decline, then we'll probably be in for some a bout of higher inflation. Let me come back to the concept of interest on reserves. There was some worry in the Fed that pumping all these reserves into the economy would boost the inflation threat. So one thing the Fed has done to kind of stifle this threat of high inflation, it's called sterilizing. Okay. The Fed is going to kind of take the inflationary potential out of this reserves increase by paying the banks interest on the reserves, roughly equivalent to the federal funds rate. Now, currently, that's only 0 to 0.25%. You might think, well, that's pretty small potatoes. Okay. The federal funds rate 0 to 0.25%, and interest on reserves, IOR, also equals 0.25%. That's pretty measly money. Why wouldn't banks try to loan this money for 30-year mortgages and get 3.5%, or prime bank loans and get 3.2%? Well, simple fact is that the demand for those kind of loans is very, very weak. Banks are probably engaged in as much of that kind of lending as they possibly can. Banks didn't necessarily want all of the extra reserves. That's why they're sitting on them that the Fed pumped in. So on this this extra bonus money, so to speak, that the Fed has pumped in to earn any interest rate on it is actually pretty attractive to the banks. And if the Fed is worried about inflation building up, all the Fed needs to do is increase the interest on reserves, and that'll keep the banks from lending it out to the market. Okay. So this is really a tool to prevent inflation. Lots of people have been critical, saying, hey, maybe we need a little bit more inflation, we need to boost aggregate demand. A lot of people think the interest on reserves is actually a kind of boneheaded move, a step in the wrong direction. But the rationale here is that when you pump almost $2 trillion in reserves into the economy, that's pretty scary and that can be dangerous. So this is kind of a safety valve, so to speak, to prevent those reserves from ballooning into a massive increase in the broader money supply, causing inflation. Okay. Interest on reserves is an important tool now. It was introduced in October of 2008. It's a pretty brand new thing. It's contractionary policy when you raise the interest on reserves, because it means banks have less incentive to make loans and expand the money supply. If you go in the opposite direction and reduce interest on reserves, or even get rid of it, after all, it's only been around for 4.5 years, that would be expansionary policy. That would let those reserves kind of flow on a normal course of banking and create more growth in the money supply. Let's wrap up. Quick review of the main tools, the big ones with monetary policies: open market operations, quantitative easing. When open market operations, traditional open market operations, reach their limit of the zero interest rate bound, you turn to quantitative easing, which can influence long-term interest rates, pull long-term interest rates down. Okay. We want to remember the lender of last resort function of the Fed is still very important. We saw that with our little glance at the Fed's balance sheet. At the height of the financial crisis in 2008, the Fed was loaning something like $600 billion to banks, to U.S. banks. That's a lot of money. Okay, that's what the Fed is there for. The Fed is arguably doing its job properly this time, whereas it didn't do this basically at all back in the 1930s. A little side note here: Ben Bernanke, the current chairman of the Federal Reserve Board of Governors, and basically the most influential person within the Fed, he is a student of the Great Depression. And he realizes, yes, the Fed failed miserably in extending credit to shaky banks and staunching the illiquidity problems in the 1930s. So as long as he's on watch, he's going to make sure the Fed doesn't do that again. In fact, they're going, if anything, err in the opposite direction. It's better to provide maybe too much than too little. Fed also loans hundreds of billions of dollars to foreign central banks and other kinds of financial institutions. Hey, reserves for everyone. Let's prevent the recurrence of the Great Depression. This is the mindset. And also the Fed has done some what we call bailouts, buying up toxic assets, buying bad loans from failing banks and financial institutions to prevent what's known as a contagion effect. The worry here is that if one large bank goes down, it has liabilities it owes to other banks, and it can impair those banks, and we can kind of see a domino effect throughout the economy. If we have time towards the end of the semester, I will revisit this concept in a little bit more detail of the financial crisis. Okay, and one final point, you want to realize the Fed, I can't emphasize this enough, the Fed has total and complete control of the monetary base. What this means is the Fed has unlimited ammo in the form of reserves to supply to banks, to help keep banks afloat in a crisis, and to boost aggregate demand. Okay, the Fed can pump in reserves through open market operations. Once it reaches the limit of the zero bound, it can pump in reserves through large-scale asset purchases. The Fed has bought something around $1.5 trillion worth of government bonds so far. Well, there's about $10 trillion worth of government debt outstanding. So the Fed could do a lot more on this front. The Fed could pump a lot of extra reserves into the economy. And if the Fed wanted to, if the Fed really wanted to, they could bring the inflation rate up to 4, 5, 6%. Okay. Now they are bound by that dual mandate from Congress that says we want you to keep inflation low and prices stable. But if the Fed wanted to, they could boost inflation. There are worries here with all the injection of reserves with this kind of hyperactive monetary policy that the Fed is going to bring about inflation, even though it doesn't necessarily want to. That's part of the debate about monetary policy right now. Okay, and a distinction we want to make between normal policy, which basically is based on open market operations. Like I said, if this was 2005, we would have been done with that page on open market operations. But with the financial crisis, there's a lot more going on: quantitative easing, interest on reserves, bank bailouts, lender of last resort stuff going on. Okay, well, that'll wrap it for our monetary policy discussion. And the final thing I want to do with our monetary policy unit is go back into history and look at some case studies of Fed activity in the 1970s. Here's Arthur Burns juicing the economy to help Nixon get reelected. Okay, here's Paul Volcker, a tough guy, Federal Reserve Chairman, brought in to bring inflation down. Here's Alan Greenspan, arguably did a masterful job. He's known as the maestro of managing interest rates and keeping aggregate demand on track during the 1990s. And last but not least, Ben Bernanke. Some people criticize Greenspan and Bernanke for holding rates too low in the housing boom, but also Bernanke will get a lot of credit for kind of stepping in and pumping up reserves and rescuing the economy and rescuing the financial system in the panic of '08 and preventing that from being a lot worse. So we'll look at a few of those episodes in a little bit more detail to wrap up this unit.
Billy Joe shot a man well out of his castle.